This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This presentation takes us through question 3 from the December 12 P5 exam. This is a question which is on economic value added, and it also goes on to look at a return on capital employed target as well. So we'll just look at the requirements as we always should do. So evaluate the performance of SS using EVA. So it means calculating the EVA and then evaluating it. And evaluating it suggests some judgment on your answer. Okay, so it's more than just a calculation. B, assess with some regulatory return on capital employed and comment on the impact. So as you often get here, kind of two parts within one: assess the ROCE and comment on the results. So let's look at the calculation of economic value added. This is a common requirement in this exam. And this isn't too bad, really. So let's think, first of all, we need to get the NOPAT figure. Net operating profit after tax, but this is before any finance charges. You can either start with the profit before tax, indeed the profit after tax, and kind of work back, or you can start with the operating profit and kind of work forward. I think it's slightly easier, what's in it, to work with the operating profit and work forward, but it's not going to make any difference. So we'll start with the operating profit, which is at 68. And then there are a number of adjustments to put through to the operating profit. And these will all be kind of highlighted to you, broadly speaking. You have to be careful about depreciation, non-cash expenses, and any provisions, because essentially provisions relate to non-cash expenses as well. So we're given some information just below here. Operating costs include depreciation 59. This is the book depreciation 59. We're supposed to be replacing that with the what's called the economic depreciation. Sometimes you're told nothing about the economic depreciation, in which case you have to assume that the book depreciation and the economic depreciation are the same, and the net adjustment is nil. You add one, take away the other, you end up where you start with in here. Here we're told, however, two depreciations here. So you add back the book depreciation, 59, and instead of that you would take off the economic depreciation, which would be 83. Now in a real exam you wouldn't do BD and EC and so on there, you'd write it out in full, but I'm talking through it, so we should be fine. This is the operating costs, including provision for doubtful debts. No, the provision for doubtful debts, the expense of that is not to be taken as an expense. If in doubt, think, does this affect cash flow? And if it doesn't affect cash flow, it probably shouldn't be in the NOPAT. Okay? So provision for doubtful debt would be added back there. Research and development. Research and development is not regarded as an expense to be frittered away. On the EVA, research and development expenditure 12 in here is regarded as an investment. So it's not an expense, it's investment, so it should be added in there. And then we have the non-cash items here, the 7, so non-cash items. The 7 will also be added back, because by definition non-cash items, they have to be added back. What we need to just look on over the page for now, we need tax, net operating profit after tax. We are given here tax at 25%, 9.5, But if we just look over the page here, we'll see that tax paid in the current year was 9, and there's an adjustment of 0.5 for deferred tax provisions. Again, if in doubt, look for money paid. Cash paid out on taxes 9. The 0.5 is in the nature of a kind of non-cash expense. So what we're going to be interested in here is taking off the tax amount here of 9. So tax paid. However, this tax will have been based not on the operating profit, but basically on this 45. And we will have within this tax here of the 9, there will be some tax relief, which has reduced that on the finance charges. So we have finance charges here of 23. The tax relief in that will be in this kind of tax charge of 9 or 9.5 will be 23 times 0.25. So it'll be 5.75. So this tax, when we've taken it off here, in a way we haven't taken off enough tax. We have to take off another 5.75 because we want the tax charge before any finance effects at all. So we want the tax charge kind of based on the 68, not based on the 45. So we need to reduce that there, and we'll call that adjustment basically the tax relief adjustment. So that should get us down to the NOPAT figure. Now we have to look at the amount of capital employed. So we've got here this figure here and this figure here. One of the biggest errors when people are calculating the EVA is to take the wrong capital employed figure. You must take the opening capital employed. Okay, not that one. It is the opening capital employed of 637. The argument kind of is you've got this 637 at the start of the year. This is what you're using for the purposes of making profit during the year. You can put up all sorts of arguments. It should be the average and so on. That's not the way it's done. And remember, economic value added is a trademarked way of working out a figure. So it's not really up to us to argue too much about the way the inventors said it should be done. What we need to adjust for this is, as far as possible, any double entry which kind of relates to these adjustments that we've done up in the NOPAT figure. So going down this here, we have the provision for doubtful debts. The provision for doubtful debts is the profit and loss account figure. And if we look at note 4 down here, we'll say the provision for doubtful debts was 4.5 at 2012, and we know there was a charge in 2102 of 2. So at 2011, the kind of carried forward to 2012, it must have been 4.5 minus 2 equals 2.5. So basically we had bad debts, kind of a historic bad debt provision to 2.5, which shouldn't be there at all, increased by this year's charge of 2 up to 4.5. So the capital employed, if there'd never been any bad debts provision ever in the history, would be 2.5 greater. Next thing we have to look at is, let's say, other non-cash items. With 7 this year, with basically 6 was charged during 2012. 1.1. If this 6 hadn't been charged, then the reserves were that much greater. So the 6 will be in there as well. Research and development could also be done the same way. If we had a research and development expense last year of 10, say, you want to say, well, that research and development should never have been charged to P&L. It should always have been charged, it should always have been capitalised. We'd have added 10 back there, but there is no R&D to add back because it only started this year. So here we have the provision for bad debts. Here we have the non-cash expenses in there. And I don't think there's anything else to adjust the amounts by. What tax provision, research and development is not capitalized. New project, 637 plus 8.5 is going to be 645.5. So we're just about home and dry now. All we have to do is to work out the WACC and then apply that to the capital employed. So here's all our WACC type information in here. So we've got equity 16% and there's a 40% make up in the capital of that, so 16% times 0.4. And then we have the debt, but that's pre-tax. WACC is always post-tax, so it's going to be 5% times, and the tax was at 25%, I think. Let me just check. So 1 minus 0.25 times 0.6. So we've got 6.4 in there plus 5% times 0.75 times 0.6, 2.25 is going to be coming out at about 8.65. So we have the NOPAT figure, which is up here at 50.25. So I'm going to do this down here. EVA 50.25 minus the adjusted capital figure, which was 645.5, multiplied by the 8.65%. Coming out at minus 5.6, I make it. So minus 5.6 means that the company is destroying value. The cost of providing the capital, which is that figure, is greater than the net operating profit after tax. So we're essentially paying more to raise the finance than the finance is returning for us. It might be because in this industry, if we've read the whole question, you'll see that they are a utility company here, formed when a government privatized a water company here. It's a government regulated industry, and there are various sorts of regulations around about how much the company is actually allowed to earn. And this may be keeping a lid on the profitability of the company, and which is going to give rise to a negative economic value added. This will give particular problems if the company needs to raise more capital for expansion or modernization. Part B asks us to assess whether SS meets its regulatory return on capital employed target and to comment on the impact such a constraint has in the performance of management. Now, what is this target here? Let's read this paragraph here. The target pre-tax return on capital employed set by the regulator is 6%, And if it were to breach this figure, the regulator could fine the company. So it has to stay below 6%. That's really what we need it to be doing. What is the current return on capital employed? So return on capital employed, nothing fancy in this. It would be the operating profit of 46 in the regulated business. As measured by the regulator, the capital employed is 779. So 46 over 779 is going to be the return on capital employed is 5.9%. So we get away with it. No fines going to be coming along there, but we're more or less right up against the barrier there of return on capital employed. We're not going to be able to increase this operating profit very much. If what we're thinking of is the EVA is disappointing, then I think most of our rescue of the company, if you like, is going to have to come from the non-regulated business here. Expanding that, making it maybe even more profitable, and so on. We can see just how bad the situation is if we even work out, the gross margin here. In a regulated business, we're making 46, sales at 276, about 16.7%. Here we're making 22 over 69, is about a third really, 32%. If we were to increase to 16.7, then of course we'll probably breach this limit that the government has put on, and we come in for big fines, which presumably bring us way back down below current performance, and actually to hurt people. We're asked to comment on the impact of such a constraint on the performance management of SS. Well, I think I would say that the managers of the regulated business are doing really rather well here. They're right up against the 6% limit. And we should probably set performance management targets, something like stay as near as you can to the 6, but don't you dare go above it. For the non-regulated people, we can be much more ambitious here. We can try to squeeze more profit out of it. We're not told what the capital employed in the non-regulated what is, but we can maybe expand that. We can get greater cost efficiencies. We can try and put our prices up and so on. And hopefully by increasing the non-regulated success, putting a lot of performance measurement in profits, in return on capital employed, so on, we can rescue the whole company out of its negative economic value added situation that it's currently in.